You've probably run the numbers on your 401k more times than you can remember. You know that balance almost by heart. But there's another number sitting on your personal balance sheet that you've probably never calculated, not even once. And for a lot of people watching this, it's actually worth more than their retirement account. It's the equity in your home. Meet Derek and Travis. Same neighborhood, same age, 52. Both have mortgages that are nearly paid off. Last year, they each realized they were sitting on more than $200,000 in home equity that wasn't doing anything. Derek turned that equity into a growing stream of dividend income that's still paying him every quarter. Travis tried almost the exact same strategy and ended up paying more than $11,000 in a single tax year. Same amount of equity, same starting point, completely different result. The difference wasn't luck, and it definitely wasn't because Derek was some kind of financial genius. It came down to 4 specific rules buried in the tax code and the mortgage system that almost nobody takes the time to explain. Here's what we're covering today. First, why your house may already be a larger retirement asset than your 401k, whether you've ever thought about it that way or not. Second, the exact IRS rule that determines whether the interest on borrowed home equity is actually deductible, and the mistake that caused Travis to lose that deduction entirely. Third, the dividend tax rule that quietly turned what Travis thought was his biggest financial win into his biggest tax bill of the year. And by the end of this video, you'll have a simple formula you can plug into your own numbers tonight using your own home. So let's start with the account you've probably never thought to check. According to the Federal Reserve's Survey of Consumer Finances, the median American between the ages of 55 and 64 who has a retirement account has about $185,000 saved. But here's the statistic that almost nobody talks about. Only 57% of households in that age group actually have a retirement account at all. Meanwhile, nearly 78% own a home, and the median value of those homes is around $350,000. Read that again. In your age bracket, far more people have access to home equity than have meaningful retirement savings. Think of it as a second balance sheet. It's an asset you've probably owned for years, but almost certainly haven't been treating like an investment account. Across the country, homeowners are sitting on roughly $11 trillion in what's known as tappable equity, the amount they could borrow while still leaving a healthy cushion in their home. That works out to roughly $200,000 to $210,000 per homeowner, according to ICE's latest Mortgage Monitor report. And here's what's surprising. That same report found that homeowners are tapping only a tiny fraction of that equity each quarter. In other words, almost nobody is using it. That's not an accident. Most of us were raised to think of our house as simply the place where we live, not as an asset sitting on the same balance sheet as our brokerage account. Derek used to think exactly the same way. What changed was that he learned how the IRS actually treats the interest on borrowed home equity. Travis never did. There's another detail that depends entirely on where you live. Not every state treats home equity the same way. Take Texas, for example. Homeowners there hold some of the least used home equity in the country, largely because the state constitution places tighter restrictions on home equity lending. Utah sits at the opposite end of the spectrum. Homeowners there tap into their equity more than almost anywhere else in the United States. So if your state has its own lending rules or restrictions, the mechanics of everything we're about to discuss can change. It's worth checking your state's regulations before assuming this strategy works exactly the same everywhere. Now let's get to the headline numbers, because you shouldn't have to sit through 12 minutes before hearing the real math. Today, a typical home equity line of credit, or HELOC, carries an interest rate somewhere around 8 to 8.5%. Meanwhile, a well-diversified dividend ETF might yield somewhere between 3 and 4%. At first glance, that looks like a terrible trade. You're borrowing money at 8% to earn 3. If someone tells you that's free money, they're selling you a fantasy. And that's exactly the mindset that got Travis into trouble. The opportunity here isn't about generating positive cash flow in year one. It's about 2 different forces working together over time. First, a tax deduction that very few people understand well enough to use correctly. Second, dividend growth compounding year after year until it gradually closes what begins as a negative spread. But neither of those advantages matters if you miss the very first rule, because if you get that rule wrong, you lose the deduction before you ever receive your first dividend payment. So let's fix that first. The rule is called interest tracing, and it's tied to IRS Form 4952. As of 2026, the old belief that home equity loan interest is deductible regardless of how you spend the money is officially dead. On July 4th, 2025, the One Big Beautiful Bill Act permanently locked in the stricter standard. Today, interest on a HELOC only qualifies as deductible mortgage interest if the borrowed money is used to buy, build, or substantially improve the home that secures the loan. If you borrow against your house and invest the money in stocks instead, that interest no longer qualifies as mortgage interest, period. That's the rule. But here's the part almost nobody mentions. There's an entirely separate deduction designed for that exact situation, and it's been sitting in the tax code the whole time. If you can clearly trace every borrowed dollar from your HELOC directly into an investment account, the interest on that portion may qualify as investment interest expense instead. That deduction is claimed using IRS Form 4952. There is one limitation, though. You can only deduct investment interest up to the amount of your net investment income for that year. If your deductible interest exceeds that amount, the unused portion doesn't disappear. It simply carries forward into future tax years. And this is exactly where Travis made his first major mistake. He borrowed $40,000 through his HELOC, then deposited it straight into the same brokerage account he already used for his emergency fund and his kids' savings. The moment those borrowed dollars mixed with money that was already sitting in the account, the paper trail was gone. There was no longer a clean way to prove which dollars came from the HELOC and which didn't. His accountant couldn't defend the deduction, not because the deduction didn't exist, but because Travis couldn't prove the money had been used the way the IRS requires. He lost the deduction entirely, not because of the tax law, but because of his record keeping. Derek handled it differently. Before he borrowed a single dollar, he opened a brand new brokerage account dedicated exclusively to this strategy. The HELOC funds went directly into that account. Nothing else ever touched it. No paycheck deposits, no emergency savings, no transfers, just the borrowed money and the investments it purchased. That one decision gave his accountant a clean, documented trail from the HELOC all the way to the investment account. When tax season came around, every borrowed dollar could be traced, and that made all the difference. But getting the deduction right is only the first hurdle. Even if you keep perfect records, there's another rule that can quietly hand a large chunk of your return right back to the IRS. This is exactly where Travis got burned a second time. I call it the 60-day rule. And it has nothing to do with borrowing. It has everything to do with how long you actually own the stock. To qualify for the lower tax rate on qualified dividends, the 0, 15, or 20% rate, you generally have to hold the shares for more than 60 days during the 121-day window surrounding the ex-dividend date. Miss that holding period, and those dividends lose their qualified status. Instead, they're taxed as ordinary income at your regular income tax rate, which can be as high as 37%. That's exactly what happened to Travis. About 6 weeks after investing the money, the market pulled back. Watching his portfolio decline while still carrying HELOC debt made him nervous. So he sold roughly half of his position just to sleep better at night. The problem? He sold before satisfying the holding period requirement. Every dividend he'd already received on those shares was reclassified from qualified dividends to ordinary income. Same investments, same dividend payments, completely different tax treatment. And simply because he sold too soon, his tax bill more than doubled on those dividends. Timing, not performance, was what made the difference. Now there's another piece of the puzzle that actually works in your favor if you understand it. And this one involves AREITs. Think of it as the ordinary income unlock. Most investors assume all dividend income receives the same tax treatment. It doesn't. According to Nariet's own data, roughly 78% of REIT dividends are classified as ordinary income rather than qualified dividends. At first, that sounds like bad news. After all, qualified dividends usually receive the lower tax rates. But remember what we talked about earlier. Your investment interest deduction is limited by your net investment income. Qualified dividends generally don't count toward that limit unless you specifically elect to treat them as ordinary income. REIT dividends are different. Because they're already taxed as ordinary income by default, they automatically count toward your net investment income calculation. No special election, no additional paperwork. That means a portfolio that includes some REIT exposure may actually allow you to deduct more investment interest than a portfolio made up entirely of qualified dividend stocks. It's one of those rare situations where the tax treatment people usually complain about can actually become an advantage. Here's a simple example. Imagine that $15,000 of a $50,000 HELOC draw is invested in a REIT fund yielding around 5%. That produces roughly $750 of annual income. Because that income is already considered ordinary income, it automatically increases your net investment income by $750. And that, in turn, allows you to deduct an additional $750 of investment interest expense, dollar for dollar. Without that REIT income, part of your deduction could simply sit unused until a future year. It's a small detail, but it's one that can materially change the after-tax economics of this strategy. Now let's put real numbers behind all of this, because if you're watching this channel, you're probably the kind of person who checks the math, and you should. Let's say you're comfortable borrowing $50,000 against your home. If your HELOC carries an 8% interest rate, you're looking at about $4,000 a year in interest expense. Now, invest that same $50,000 into a diversified dividend fund yielding 3.25%. That generates roughly $1,625 in annual dividends. So where does that leave you? You're still about $2,375 in the red during year one, and that's before accounting for any tax deductions. That's the honest math. Now let's scale it up. Suppose you borrow $150,000 instead. At the same 8% interest rate, your annual interest cost climbs to about $12,000. A 3.25% dividend yield produces roughly $4,875 in annual dividend income. You're now looking at a gap of just over $7,000. Increase the borrowing amount again to $300,000, an amount someone with significant tappable equity might realistically consider. Now your annual interest bill reaches roughly $24,000. Your dividend income grows as well, to around $9,750, but you're still behind by a little over $14,000 in year one. Notice the pattern. At every level, the numbers look worse before they start looking better. That's the calculation Travis never bothered to run. When the cash flow came in lower than expected, he assumed something had gone wrong. Nothing had. His expectations were wrong. He expected immediate income. What the strategy actually requires is patience, because the real engine isn't the initial dividend yield, it's dividend growth. Take a fund like SCHD. Over the past 5 years, its dividend has grown at a compound annual rate of roughly 8.7%, based on the fund's own distribution history. Now compare that with your borrowing cost. Assuming your interest expense stays relatively fixed while your dividend income continues growing year after year, that negative gap begins shrinking on its own. No additional contributions, no extra deposits, just higher dividend payments over time. And remember, that's before factoring in any investment interest deduction that may reduce your effective cost even further. If you want to calculate exactly how long it would take for your own numbers to break even, that's exactly what the Dividend Income Toolkit linked in the description is designed to do. Instead of calculating every scenario by hand, it models different borrowing amounts, dividend yields, dividend growth rates, DRIP assumptions, and tax treatment using your own inputs. Now let's call out the biggest mistakes directly, because they deserve more than a passing mention. Mistake number 1. Mixing borrowed money with an existing brokerage account. That's what cost Travis his investment interest deduction. Mistake number 2. Selling before satisfying the 60-day holding requirement. That decision converted qualified dividends into ordinary income and dramatically increased his tax bill. Mistake number 3. Expecting positive cash flow in year 1. The numbers simply don't support that expectation. At every borrowing level we've looked at, you're starting with negative cash flow until dividend growth gradually closes the gap. And finally, mistake number 4. Borrowing more against your home than you're genuinely comfortable carrying. This isn't margin debt backed by a stock portfolio. A HELOC is secured by the roof over your head. If things go badly enough, your home, not just your investments, is part of the equation. That's a risk you should never ignore. There's one more thing you should know, especially if you're 62 or older. At that point, there's an alternative approach that works very differently. Instead of using a traditional HELOC, some homeowners choose a HECM line of credit, a home equity conversion mortgage. The biggest difference isn't the interest rate, it's how the credit line itself behaves. With a standard HELOC, the lender can reduce or even freeze your available credit if home values fall or your financial situation changes. A federally insured HECM line of credit works differently. As long as you continue meeting the loan requirements and live in the home, the available credit line can't be frozen simply because housing prices decline. In fact, the available line of credit continues to grow over time, regardless of what happens to your home's market value. That's a much bigger topic than we can cover in this video. It deserves its own deep dive. But if you're in that age range, it's important to know this option exists before automatically assuming a traditional HELOC is your only choice. Now let's boil everything we've discussed down into one simple calculation. Call it your home equity income number. Start with the amount of home equity you'd actually feel comfortable borrowing. Multiply that by your HELOC interest rate. That gives you your annual interest cost. Next, take that same borrowing amount and multiply it by the dividend yield of the investments you're considering. That's your estimated annual dividend income. Now subtract the dividend income from the annual interest expense. The result is your real year one gap, not the optimistic version, not the marketing version. the actual number. Once you have that figure, you can estimate how many years of dividend growth it may take before the strategy begins paying for itself. It's the exact same calculation whether you're borrowing $50,000, $150,000, or $300,000. The only thing that changes is your own numbers. Now let's go back to Derek and Travis one last time, because none of what separated them came down to luck. Derek opened a completely separate investment account, making it possible to trace every borrowed dollar. That allowed him to preserve his investment interest deduction. He held his investments long enough to satisfy the 60-day holding requirement, keeping his dividends taxed at the lower qualified dividend rate. He also understood from the beginning that the strategy wasn't designed to produce positive cash flow immediately. He expected to be underwater in year one, so when it happened, it wasn't a surprise.